A thing that holds a lot of people back from getting whole life insurance is the fear of commitment. What if I can't pay my premium? This is especially true with business owners, especially those who have lived through the tough times and have had down years in the past. What if I get this whole life insurance policy that I'm interested in implementing for my company, but if I have this big premium and I can't pay it because I have a down month or a down year, it's going to stress me out because I don't know if it's going to go down in value and I just don't want to have to think about stressful things. Ever think like that? Firstly, it's okay if you have. That's crossed my mind before. I think it's completely normal. It also serves as a means of protection to make sure you don't get a bad policy, or I should say any type of bad product. So what we're going to look at today is a case study of a business owner who's interested in a whole life insurance policy, but he wants to make it as flexible as possible. You'll see that he can even make a one-time payment and never pay anything else in again, and that cash value will continue to grow. So he's interested in a whole life insurance policy, mainly for the cash value. What he's interested in specifically is one, it's a safe place to put his money. He sees that it's going to grow at a much more attractive rate than what he's getting with his bank. Two, he can use the cash value for financing purchases and also opportunities. And what he really likes is the fact that if he accesses his cash value through a policy loan, it's going to keep on compounding. And then third, he really likes the tax benefits. Now, he cannot deduct the premium and PUA payments, so he can't deduct the money he puts in, but he can access it tax-free. That's really what he likes. So in summary, it is a safe, liquid, and tax-free place for his money. So he's attracted to the product. However, there are some things that are holding him back. He can't quite pull the trigger. Now, he has cash in the bank, so he can easily start the policy and fund it with a large lump sum. He also wants to and thinks he can fund the policy with a lot of money every year, but he's just afraid to pull that trigger because he doesn't want to be on the hook for this big premium every year. What if I can't pay? My cash flow has been up and down. I think the economy and market is going to tank soon. That's going to impact my business. If this thing feels like a burden, it's going to take my focus away. And the reason I would get this product is because it should make my life better and things easier for my business. That's why he can't pull the trigger, which I totally understand. So here's the solution. You may not be aware that with a whole life insurance policy, you can make it extremely flexible. And we're going to look at a case where he's starting with a large lump sum of about $200,000. But if you're starting with a lump sum of $20,000 or $2 million, it's all relative. It's really just a case of adding a zero or subtracting a zero. So in the first year, because he has cash in the bank, he's starting with a lump sum of $200K. But after that, we want to show him the what-if scenarios, mainly to give him peace of mind and not just tell him, but show him, if you can't pay, you're going to be okay. Not only that, but your money's going to keep on compounding. So what does it look like if you pay zero after that lump sum? What does it look like if you only pay the minimum? And then we'll demonstrate how he can fund different amounts every year, which is meant to demonstrate the flexibility of the policy. And then lastly, we'll take one of those models and show you how he can use it for his business, which will particularly hit on this point, using it to finance purchases and opportunities. So the policy we're going to look at is this guy right here. We're going to look at this on Excel to make it simple, but just to kick things off, I want to show you this on the actual illustration. He's starting at 44 years old. He wants to start with a lump sum of $200,000. What we're looking at here on the insurance company's illustration is beginning the second year, he pays zero, and he pays zero forever. Never pays another penny into it. His cash value is over here. First year, 188 and change. To put that into perspective, if that was $190,000, that would be 95% of what he paid into the policy in first year cash value. So this is a policy with minimum expenses and maximum cash value, which is exactly what we want. Now he pays zero every year, beginning year 2. We can see his total out of pocket here, $200K. And by the 3rd year, he just about has all of his money back, and the cash value continues to grow after that. So this is one example of one company and one product that demonstrates funding with a lump sum and then never having to pay anything after that. Now, the next example is the exact same policy, but demonstrating him still funding the minimum each year. $200K in the first year, and then he funds $8K per year. So a question I would ask in a case like this is, hey, I know you mentioned your cash flow is up and down, and you do feel that you can aggressively fund the policy, but if the minimum is $8K per year, would you be comfortable with that? Or do you feel that that's too high? And in his situation, starting with a $200K lump sum, he's like, hey, that's no problem. I thought my minimum was going to be like 20 grand or something like that. The thing is, you can start a policy with a large lump sum and keep a very low minimum premium. Depends on the insurance company, right? So this is Guardian, which typically lets us fund a maximum of 10 times our minimum, except for the first year, we can go up to 50 times our minimum. And then here's the exact same policy. You can tell by looking at the first year cash value at 95% approximately, but now we've got different funding amounts every year. Not that he'll actually do this. This is just a concept illustration to show him proof via a visual that he can adjust his funding amount every year. Whether it's zero, just the minimum of about 8K, or up to 50K per year. So to make this a bit easier on the eyes, let's take a look at our handy dandy Excel workbook, shall we? So what we've got here is the first illustration we looked at. And this is nice because it cleanly breaks down the minimums and where our money is going. So in blue is your total out of pocket. If this is you pay $200K per year. That's your lump sum amount that's just sitting in the bank. Goes in, first year cash value, 188 and change. You also have life insurance now, which does serve as key man insurance because this is the business owner and he does not have life insurance right now. This is really meant to display a worst case scenario because I'm paying zero thereafter, but I see the cash value continue to appreciate over time, which is fantastic. We have people that we work with that actually do this. So it's not just an illustration showing, hey, here's what it'll look like. No, people actually do this kind of stuff, which is cool. Now, his intention is to do something like this. I want a policy where I can start with the minimum only, but then only be billed for the minimum. And then if my cash flow permits, I'd like to add more money to the policy and see it show up in cash value right away. That's what he wants to do. So this demonstrates the first phase of this, where he starts with a lump sum in the first year. And then the second year, here's his minimum of 8K. His annual funding is 8K, just the minimum premium. The minimum premium, do you think that goes to cash value? It does. I always like to mention that because typically I hear the word premium and I think auto insurance, term life insurance, homeowners insurance. It's just a premium I pay. Goes out the door, and if something bad happens, an insurance benefit is paid. With cash value life insurance, when it's set up right, I see it build cash value. How you can tell here is in the first year you're at 188, you paid 8, and now you're at 202. If you got just your 8 back, you'd be at 196. But we're more than that. So we're getting our premium back, and it's compounding for us. Then he breaks even in policy year 3, which is fantastic. Why the death benefit goes down, by the way, after year 8 or after year 7, that's an option we're exercising here. It won't automatically happen. If I'm working with someone and over the years, I see that they're not max funding the policy, they stopped or they're paying just the minimum, I want to cut the insurance expenses to the minimum to allow the cash value to grow at a faster pace. And the earliest we can cut the death benefit and still keep it tax-free, that third bullet point, is policy year 8. There's a 7-year rule. It's referred to as my MEC or MEC test with a life insurance policy. But this is what he wants to set up in terms of being committed to. So he's committed just to this. And then we have another concept illustration, all with the exact same policy. We don't have to commit to one option up front and then do the other. No, I'm setting it up where I'm only billed for this. And then at my discretion now, this optional PUA, PUA stands for paid up additions. I like to call that my cash dumping. Cash dump, that's me throwing extra money into the policy. The minimum plus my optional PUA equal the annual funding. Look at this. It's a growing, which is nice. I don't have this highlighted in yellow. When's my break-even point? It's year 3. I've paid in $260 in this example, and I've got $262 and change. But again, with this policy, we've alleviated that concern of being committed to a big amount. $8K is not a concern for him. But at the same time, if he cash flows, he wants the option to pay up to $50K some years. And there have historically been times where he's been able to, where he's cash flowed heavily and he would be able to continue to fund the policy. That's what this is meant to demonstrate. So, all one policy, showing what it looks like, just set up for flexibility and maximum cash value. Let's wrap this up by showing how he could actually use the policy to finance opportunities. So, he has a project that he wants to deploy a lot of capital to. By the age of 50, when he's 50, I should say, he's going to need to put about 300 grand here. So what we want to look at is using the cash value, taking $300,000 from it, how it impacts our policy, and then when we pay it back, what's the impact on our cash value, death benefit, everything. Here we go. So what we've got is our loan workbook, which is something we provide to all of our clients. I love this thing. What we've got are the policy values based on what he thinks is realistic, the varying funding. So total payments tallies up all of his annual payments. He's 44 right now, so we've got 44, 45, 46, 47, 48, 49, 50. Total amount he's paid, $330,000. Cash value, $368,000. So his cash value is $368,000. Yearly cash value growth, this column in purple, is showing what you are getting from the insurance company every year. So at age 50, he got about $10,500, meaning the year prior, he was at $333,000. He added $25,000 to it. That doesn't count toward your $10K in growth. I just want to know, after we back out that $25,000, what's the total growth? It would come out to $10,540. In fact, let's do that with a calculator real quick so you can see it. So take your cash value of $368, there we go, $368,929 minus $333,389 minus your payment of $25,000, and there's your growth of $10,540 at the age of 50. All right, cool. So that's his actual growth. Now we want to look at using the policy. The maximum loan represents 95% of whatever you have in cash value minus your loan balance. Because when you take loans, it's going to reduce how much you can borrow. However, when you take loans, you keep earning interest on your entire cash value. Continues to compound all the way through. So he wants to take that loan out here at the age of 50 of $300,000. The maximum loan is $350,000 because his total cash value is $368,000. So if he takes that $300,000 loan, what happens? Here we go. We'll make no principal payments in light blue. The interest rate, this is with Guardian, it's fixed at 4.76%. In fact, what he'll probably do is take a cash value collateral loan, which means he'll assign it to a bank, Makes it easier to deduct the loan interest in many cases. And those rates are a little bit higher right now. Let's put it at 6% actually, just to try and make this scenario look worse. So if I make that loan interest rate 6%, $300,000 at 6%, $18,000 and change. We're assuming he's paying the loan interest here. So he pays $18K. The growth that year was $10,540, which means he has a loss of $76.40. It's important to see that up front. Now, if he pays interest only for the next several years, what happens? He runs a loss, but that loss lessens every year. Why? Because that cash value growth is occurring on the full cash value here. You pay interest only on your outstanding loan. You earn interest on any money loaned and unloaned. The death benefit, I've got condensed here, but with a $300K loan, you would see reduce dollar for dollar. So the year you take that loan out would drop to $3.4 million. So let's assume he begins to repay it the next year, and to make it simple, we'll apply $30K per year toward the principal. That times 10, we'll pay it back. All right, so as he's paying that back, loan balance is coming down, down, down till it hits zero. Every year that he pays the loan, the following year, you'll notice less in loan interest because interest is going to accrue on a lower balance now. And then when it's eventually paid off, I see my positive spread on the far right, and that is the annual positive spread. So the spread is meant to provide transparency around how much he is earning net after factoring in the cost to borrow every year. And with this type of workbook, this is something we do provide to clients where they can model their own loans, different payment schedules. It works a lot like a line of credit. I will say that this is not meant to serve as an actual illustration. We always run those so you can see what the numbers look like with the actual policy, especially if the company you have is direct or non-direct recognition. It'll change things a little bit, not much, but a little bit. So we just want to make sure the numbers are accurate. In any event, this gives you, call it 90 to 95% accuracy. It'll be quite close. But this is meant to show the impact on the policy. What it does not show, which I would like to include in this example, is that $300,000 opportunity is going to produce a return. Hopefully, it probably will. And then that return, we could add on top of the spread to see his overall earnings here. A lot of people like to see that. A lot of guys and girls we work with involved in real estate like to see that kind of stuff, to see, hey, what's my total return when I use this policy? Anyway, the original concern he had of committing to a big premium, which was preventing him from using this policy, from even starting it, is alleviated because he saw that he can commit to a minimal premium amount. Now again, the insurance company selection is important here, as not all companies allow lump sum payments. Of the 4 major mutual companies, Guardian does. That's why I use the Guardian illustrations. You will see some smaller companies allow lump sum payments, which is nice. But the company is important. If you're working with a company that does not allow a lump sum payment, how you would make this work is we would spread that lump sum out over the first and second year, and you would see very, very similar results, and we would also be able to keep that minimum premium low as well. It just has to do with discussing the individual's situation. And in my opinion, it's just treating them how you want to be treated. Because all of this stuff, often that we talk about with clients, are all concerns that I've had before, or just thinking, hey, if I'm in their position, if this scares me, how would I get around that in terms of building the policy so I don't have that stress anymore? Because less stress lets me focus just on the business, which generates more revenue, which puts me in a better position so I can put more money into the policy, business grows, everything is better. Anyway, I'm going to stop rambling now. I hope you enjoyed this one. I had an absolute blast with it. I'd love to hear your thoughts. Any comments, please leave them below. If you have any questions or would like to connect, feel free to email me. We've got my email address below. You can also check out our website, ibcglobalinc.com. And if you have a policy and would like a free second opinion to see if it could be crafted this way, feel free to reach out. We always like to help. Thank you so much.